Last year was an incredible year for precious metals with gold up 60%, silver up over 140%. And here we are in the first few weeks of January, and it looks like the flow is going to continue on into these precious metals. Can you give us a sense of what you're seeing in the various products at Sprott?
Yeah, I mean it's been about 4 weeks since we last spoke, and the momentum has not slowed at all. We had an incredibly busy second half of December, which historically does not happen, as a lot of market participants and investors kind of take the holidays to themselves. But that was not the case this year.
Gold was up 60% in 2025, making it the best year for gold since 1979. So, what's driving this out? While central banks continue to buy gold and record amounts acquiring 25 to 30% of global production, and they're doing so to protect their US dollar reserves against never-ending inflation and a falling US dollar. Central bank gold reserves have overtaken US Treasuries for the first time since 1996. Another factor contributing to the higher gold price is fiscal uncertainty associated with record debt levels. The federal debt is approaching $40 trillion and is growing by $1 trillion every 100 days. And interest payments to service this debt is at $1 trillion annually. So where's the gold price going, and what gold producers should investors consider? Now we present the clips from Jimmy Connor and John Ciampaglia's interview. Before we continue to discuss this, please subscribe to this channel and activate the bell icon for timely updates. Thank you and enjoy the video.
We had an incredible December, and the momentum has continued right through to January. And it's not just gold. We're seeing it in silver. We're seeing it in uranium. We're seeing it in copper. A number of commodities, specifically related to energy metals and alternative currencies. If you want to think about gold and silver as being alternates to fiat currencies, continue to have very strong interest from investors around the globe.
And you said there was an acceleration in the month of December. Why do you think that is?
I think people are getting more and more concerned about some very unconventional, let's call it policy, whether it's things related to trade, tariffs, Venezuela, Iran, Section 232 reviews. This is the strategic reviews the U.S. is doing right now on a number of different strategic commodities that they deem to be of national security importance. And I think as some of these developments become more and more in terms of pushing the boundaries, I think investors are thinking more about protecting their portfolio against potential shocks or market dislocations. And I think that's where gold is kind of coming in here. Investors are shunning the historic safe haven of US dollars and treasuries. Those two things have been under pressure. The US dollar was soft last year. Treasury yields are just not providing the level of return, particularly on an after inflation basis for investors. And investors are also concerned about the very large US debt level and the Treasury's inability to really extend out the term. Nobody wants to buy long dated treasuries. And so that's really forcing them to roll a lot of short dated debt on a more frequent basis, which I think creates some rollover risk of that debt. And that is another factor that I think is in the minds of investors right now.
And how would you characterize the investors? Are they retail, institutional? Are they Americans? Are they Europeans?
Yeah, I think what's interesting is we're kind of getting a synchronized level of global interest in gold right now. You have the tried and true stalwarts in places like China and India. These are societies that like to put savings into hard assets like gold and silver. That group has been very, very active in terms of accumulating not just physical, but also buying gold and silver in certificated form, meaning buying it through exchange listed offerings in both markets. We've seen very strong inflows into both those markets. In the Western world last year was a real big sea change in terms of interest across all investor segments. We saw about 45 billion US dollars come into Western listed gold ETFs last year. And that's a really big increase over the prior year. But when you put it in the context of just the flows into US ETFs last year at $1.5 trillion, 45 billion doesn't seem like a whole lot. So a lot of returning investors to gold, but it's still, I would say, a very small population.
So let's talk about some of the fiscal issues that you touched on, and we can't ignore the federal debt levels, which are approaching $40 trillion, and they grow by $1 trillion every 100 days. These numbers are just staggering, and the interest payments on that debt is over $1 trillion now, and so the government's been very aggressive in trying to get interest rates lower because they want to. I think they have about $8 trillion in treasuries that are coming up for renewal this year or that are maturing. So of course they want to get the interest rate lower so their interest payments are lower. But it sounds like the Fed or the new Fed governor is going to take a very dovish stance, and they're going to try to get interest rates as low as possible. Sometimes, like, I think I've heard various people within the administration as low as 1%. But I want to get your thoughts on this and what you think that does to inflation.
Yeah, I mean, I think what we're concluding, and we've been writing about this at Sprott for the last few months, is this current administration in the US is very willing and open to run a very hot economy, meaning a lot of fiscal stimulus, a lot of money printing and debt to fund all of these different programs that are being announced constantly. And also, you have a lot of pressure coming from the president on the Fed to not just change the Fed governor, but also to push interest rates lower to ease that debt burden. And the flip side of that is around questioning the independence of the Fed and whether there's going to be undue influence on monetary policy. If that were to play out, obviously you run the risk of much higher inflation in the economy. I think that's one of the reasons, as I mentioned, treasuries don't look as attractive. Um, but it also, I think, speaks to the days of this 2%, inflation target that a lot of central banks have held on to for the last couple of decades. I think that's kind of well behind us. The inflation rate is likely to run much higher. Inflation is not being helped by obviously tariffs, which are inflationary, and as well as disruptions that we've seen in a number of different supply chains. So our belief is inflation is heading higher as fiscal policy remains very, very accommodative, and it looks like monetary policy is moving in the same direction.
And of course, this is going to bode well for the price of gold, but you touched on US Treasuries. I've seen many reports saying that central bank gold reserves have surpassed central bank treasuries for the first time since 1996.
Yeah, it's astonishing, and I mean, obviously, it's a function of two things: one, the price of gold going up, and two, central banks, a number of them deciding that they want to have a higher percentage target of gold as their reserves relative to currencies and other sovereign debt. And this is happening with a number of central banks. The most prolific, I think, rotation we're seeing is obviously in China, where China historically has held hundreds of billions of dollars of US debt on its books. And what we're seeing is a very clear deaccumulation of those treasuries and rotating a lot of that capital into other hard assets, including gold, including infrastructure that they're building domestically, as well as financing in other countries to secure supply chains, et cetera. So there is clearly kind of a de-dollarization, deaccumulation of treasuries going on. And one of the big beneficiaries of all this has been physical gold.
And to your point, the US dollar was down 10% last year, and it looks like that trend is going to continue. But if they continue to cut interest rates, I can only imagine the US dollar is going to go lower, which once again is
Yeah.
going to bode well for the gold price.
Yeah, absolutely. I mean, despite a lot of jawboning about, wanting to have a strong currency, I think the reality is when you're in a global trade war, the one of the direct consequences of that is weaker currencies across the board. And I think that's why gold is basically being repriced higher, if irrespective of whether you live in Canada or United States or in the European Union or Switzerland, the price of gold is going up because your currency is becoming weaker as countries let their currency slide to basically mitigate some of the risks of this trade war and obviously shifting world order that we're seeing in terms of trade policy.
And we can't talk about the gold price or the US dollar without talking about the money supply. And I know a lot of people are shaking their heads. Why do you want to talk about that? But if you look at January of 2020, the money supply as measured by M2 was just over $15 trillion. Here we are 5 years later, and now it's over $22 trillion. That's an increase of 42%. But this also speaks to why the price of every good, service, and asset class has gone up 30, 40, or 50% in the last 5 years.
Yeah, absolutely. I mean, the inflation doesn't magically appear without a catalyst, and the vast amount of money printing that really started with COVID and has continued unabated has really, repriced the good of all, the price of every good and service in the world. That is obviously being felt, particularly by younger people, as we know, who are caught by that. And it's going to be a persistent issue, I think, as unless policy starts to shift to be more fiscally responsible. We think inflation is going to run hotter than it has for the last couple of decades, which is, I think, something that not every investor is thinking about. But if, let's say, you're an insurance company with very long dated liabilities, you need to think very differently about what those inflation expectations look like over the next 10 years versus historical levels if you have indexed liabilities and obligations to your plan members. So I think for every investment capital pool, you have to think a little differently about how it impacts you. But I definitely think it's having a knock-on effect across the board.
So, John, many of the factors that we have spoken about in the last few minutes, they're all very bullish for gold. The fiscal situation, the lower US dollar, ongoing money printing. But if there was one concern that you have that might lead to a lower gold price here in the coming months, what would it be?
Ooh, that's a good one. It's hard to see what would cause a big pivot back to paper. And I say that because I think people are very focused on holding real things and hard assets right now over paper assets. Um, and so it's hard to know, given the signals that the market is flashing, China's willingness to take gold up significantly higher, we believe, in its reserves because of the treasuries that it is slowly, reducing on its balance sheet. We think there's a lot of dry powder there. We also see, huge buying groups with very large savings pools. And I'll just, use one example of China. The Chinese are obviously incredibly hardworking people and save a lot of their earnings, well over $20 trillion of savings there. And you think about, if you were there, what can you put your money into? Well, let's talk about the property market, which has obviously been a huge source of funding for people's savings. Well, the property market has gone down for 6 years in a row there. So people are not investing in real estate. Are they investing in stocks there? Well, the stock market's been really challenged as well the last few years. So what can you buy? Can you buy foreign assets? Well, no, there's capital controls. You can't move your money offshore. So what's left? Well, things like gold and silver. And I think that's why we see a very persistent bid by those groups of people. Same thing with India. There's obviously a long-standing tradition of buying gold, and as the price of gold has increased to levels beyond the reach of some people in India, we've seen massive substitution in the fourth quarter towards physical silver. In the month of September and October alone, India imported 85 million ounces of silver. That's a huge percentage of above ground stockpiles. So all of these buying groups, acting together, I think has put incredible upward pressure. And it's hard for us to see in the short term what changes. Could a change in administration change the election, in the midterms? Maybe some of these things, but I think the genie's out of the bottle, so to speak, and that the secular changes that are underway right now are not transitory. They're not temporary in the sense they're going to last for 1 or 2 years. That these are moves, strategic decisions that central banks and investors are making in response to a breakdown in the global world order that we've had since the end of World War II. And I think it's going to take people a long time to change their view that we're going to go back to what we had. I think it's a bit of a shock and awe phenomena, and it's going to take time to adjust back.
So I understand why a country like India would be buying gold because it's a reserve currency, but why are they buying so much silver?
Yeah, I just think as the price of gold has become unaffordable for think about the lower, socioeconomic population grid, which are largely unbanked still, and still, channel a lot of their savings into precious metals. That silver has become one of the substitutes. We'll see if that continues now that the price of silver has, almost well, more than doubled since November. So we'll see if that trend abates, but clearly there is a scramble for metals. There's been scarcity as well by location, and retail investors as well as institutional investors all seem to be acting in a coordinated fashion right now.
Well, John, this has been a great discussion. I want to thank you very much for spending time with us and sharing your thoughts. The one thing that Sprott does very well is they provide a lot of resources for investors to learn about precious metals, base metals, and many other products. Jamie, thank you so much for joining us today.